Let's get some analysis. Larry Shover, Chief Investment Officer at SFG Alternatives, joining us live now from the CME Group in Chicago. Larry, great to see you as always. Yeah, I mean, just in terms of the moves higher in markets, the record highs for the S&P 500, it's interesting, isn't it, that this is happening? We should be celebrating, yet there's a lot of nervousness about this, a lot of incredulity, if you like.
Bridie, that's a great way to put it, and I think that's exactly why we continue to march higher. This continues to be a hated market, and because of that, we have a really sturdy wall of worries to climb. And I do think short-term, the pain trade continues to be higher. I mean, let's bear this in mind. We have three chief narratives that drove the markets this past week, meaning last week and today, and that's pretty good global data, especially PMI numbers. We had really stable housing numbers in the U.S. and central bank commentary. So all three of those, you add them up, we're going to continue to rally until further notice, because I think it continues to be a much hated market.
You say everyone seems to have a view that there is a correction, though, coming at some point, possibly 10%. But also, I mean, the correction doesn't have to be a fall either. It could just be trading sideways for a long period. Right.
Yeah, and I think that's the most likely scenario. I mean, obviously, we could get some type of tragic news come out and drop 10% in a heartbeat. However, I think the harder type of correction is what we basically have just been seeing, as a rotation out of small caps into other things, and we could continually see that happen over the next 6 to 12 months. What's to stop it if our narrative remains in place?
Bonds, though, it just doesn't seem to be taking the usual track. Normally equities rising would see bonds coming off, yields rising, but that hasn't happened. What's your view on the way the bond market's been behaving?
Yeah, I think it's just we've gotten our heads around the fact, or our arms around the fact, as it were, that this is all about anticipation for June 5th in the ECB, with Mario doing something, pulling another rabbit out of his hat. It's really not about the global economy. It's more about that. However, with that said, it still troubles me that yields are as low as they are. What that's telling me is that we are growing. We're just not growing as fast as we probably or once thought we were.
With the ECB meeting next week, obviously the expectations are growing that there'll be something. There'll be a rate cut, perhaps not QE. Yeah. I mean, what's the view there, and what happens if the ECB sits on its hands for another month?
I think that would be really difficult for the market to internalize, because it's a foregone conclusion that they're going to cut the refi rate 10 to 20 basis points, and other than that, they could sterilize S&Ps or set out another LTRO. But I think the market, some people in the market are really counting on some type of asset purchase, some type of quantitative easing, and I'm not sure how that's all going to play out. It's going to be very fascinating to see. If it does happen, I actually will be surprised, because that would be something very, very difficult to engineer on the continent.
And for the US session, the performance of the stocks, I mean, how much was, the growing expectations surrounding the next ECB meeting, how much of that was behind the rally on Wall Street, do you think?
Well, I think it's a good part of it, just because, again, we're going to see another central bank that's willing to be accommodative, just like the US, the Federal Reserve has been. So with that in mind, yields go lower, there's nowhere else to put your money, and we go out the financial repression system and continue to buy stocks, even though our multiples are climbing, not in the danger zone yet, but basically on the high side of where I feel comfortable.
A lot of economic data out of the US, durable goods impressing, consumer confidence rising.
Yeah.
What did you make of it? And, do you get the sense that, the economic recovery is on track?
Yeah, but backing up the durable goods number, I do believe that was more of a mixed bag. I mean, I think the durable goods number itself came out good. The capital goods order was a little bit more of a mixed bag. And yes, there was an upward revision from the month prior, so that's good. Again, I think it just continues to sow that tapestry that our economic data continues to climb in the right direction. And so therefore, people are very willing to own risk assets like stocks.
So what are you doing then in this environment at the moment with, expecting a period of sideways trade?
Well, I'm still looking long term, but with my fund, I'm more into momentum, and I'm still bearish on gold. Although as an investor, I would still own it. I know I'm talking out of both sides of my mouth, but investor, I'd own it. Trader, I'd stay short it. Copper had a nice run today. I still don't like it right now. I don't think the fundamentals are there, and I do like the U.S. dollar, especially against the euro, so remain there.
And just in terms of gold then, I know that was interesting what you were saying there. I mean, this 2% fall overnight, what do you put that down to? Just stocks doing well?
I think the latest move is basic. Yeah, well, I think part of it, I think it's just a realization that the normalization of U.S. monetary policy will continue to be a cross over gold's head. It's going to be very hard for it to rally, and then we also have easing or perceived easing geopolitical tensions out of the Ukraine. Again, it's perceived. If we didn't have that, gold probably would have been at $12.68 an ounce in U.S. terms before this all played out.